Hi everyone. In our previous video, we spoke about some of the key metrics that have to be considered for dividend investing. So, in part three of the series, we'll talk about some of the signs of a safe and stable stock for dividend investing and some of the key red flags that have to be avoided. So, let's look at some of the safe things first. So, the first thing is you should have a stable and profitable business model. So, consider a company like Nestle. So it is consistently growth. So if you look at Nestle, they have been growing. In 2013 December, they were at 9,000 crore. Now in 2023, they were at 19,000. Now they are so a company that has been growing on a consistent basis. So you should look for companies with strong growth history in sales. So if you look at a company like Jet Airways, they could not grow consistently. They declared bankruptcy, so dividends stopped coming. So if you are investing in a company like Jet Airways with the dividends in mind, you have to be very careful. You should not consider such company. A stable company like Nestle is good enough for your dividend portfolio. The second thing is you should have very low debt and you should have strong financials and numbers. So let's look at HCL Tech. So HCL Tech has very low debt. If you look at its debt equity ratio, it is 0.08, which is like literally zero. And the company should pay consistent dividends. So let's look at HCL numbers. So dividend payout. So they've been paying dividend consistently over a period of 10 years. So every year, so the dividend yield is very good, 3.5%. And the company is providing a healthy dividend payout ratio. So though it's high right now, in the last 3 years it is very high, but still the company is consistently paying dividends for the last 11 years. So there are companies that struggle with very high debt and they may not be able to pay dividends. So Z Entertainment is one such example. Let's look at Z Entertainment. So if you look at this company, so Z Entertainment, let's look at it. So they started paying dividends, and then dividend payout ratio started going down. 2020, they only paid 5% for namesake, and 2 years back, they did not pay any dividends. So there is very high inconsistency here. They have a debt issue. They had a debt issue. Now they've recovered and they are paying dividends now. So any company with high debt is something that has to be avoided because such companies will not be able to pay dividends on a regular basis. They'll cut on that, which means that you are losing your share of the profit from the company. So the next thing is to look at the long-term track record. So how many years are they paying dividend? Are they paying every year? Are they increasing dividends every year? Now, in this scenario, we'll look at Asian Paints. So Asian Paint has a dividend yield of 1.56%. And if you look at their dividend payout, it is very consistent over the last 10 years, 40 to 60%. 40 to 60%. So very healthy. It's very healthy and they have a good results. They have strong track record in terms of dividends. So whereas a company like Yes Bank was doing well once. Let's look at their dividend paying history. So the company was doing really well. They are paying decent 15 to 20% payout. Whereas from 2020, they stopped paying dividends. So companies should have a consistent track record. Look for companies with 10 plus years of dividend payment history. Even if you want to invest in a stock for long term, even if you're looking to invest in it as a growth stock, look at dividends. It also means that the cash is real, the cash flows are real, the profit they generate is real and not fake. So the company should have a sustainable business growth, consistent revenue growth, consistent profit growth, like how Dauber is doing. So they are consistent. So from 6,000 to 12,000 crore. And from a net profit of 750 crore to 1,800 crore, they've come a long way and their dividend payment is very good, 30 to 50%. Whereas if you look at Reliance Communications, their business is not doing well. So 20,000 crore declined from 25,000 crore to 6,000 and now at 350 crore. So look at the dividends. It stopped after the first year because of declining business. So you should always look for companies with steady sales growth, steady profit growth, low debt. The company should not have any debt. And the fourth point is long dividend track record. So now let's look at some of the red flags, dividend stocks to avoid. So any company with a high dividend yield, about 10%, is risky. It means that the company itself does not get any support. It means that you are getting at 10% interest. In FD, you get 5.5% interest. Here you get about 10%. It means that you will get a lot of investors purchasing the shares of company at 7-8% dividend yield. If that is not happening, then it is a red flag. The second reason could be due to debt or other needs. Company promoters may be issuing a very high dividend yield, which is a cause of concern. So you should avoid companies with dividend yield that is way too high. Up to 7%, 2 to 4% is ideal. 6 to 7% is the maximum you can consider. Anything above that is a red flag. So any company with declining earnings and declining revenues should be avoided. So for example, BPCL. So whenever there is a change in crude oil price, their earnings and revenue growth will fluctuate. So dividends remain unpredictable. It won't be the same every year, which is not something we are looking for. You can see here 25, 35, 30, then 100, 29, 40, 33, 106. All the numbers, right from 1 to 110, all the numbers are here. So it's better to avoid such companies with declining earnings and declining revenue. And then if the payout ratio is more than 80, this is again a red flag because the company may not be able to pay the same thing on a regular basis. First point. The second point is the company does not have any other source of growth. That's why they are paying the dividends back to the shareholders and the management. So if the dividend history is not consistent, again avoid. Tata Motors cannot be a good dividend portfolio stock because they pay dividends in some years, they don't pay dividends in years where they do not have proper profits. So this company suddenly paid dividend in 2023, 2024, but before that, 2016 was there, they paid dividend. This company is a an avoid when you are building a dividend portfolio. And the next one is debt. If the debt is high, all your cash flows will go towards servicing the debt. All the cash flow from operations, free cash flow you have. Beyond that, you have cash flow from finance. So all the money will go away into paying your interest, paying your debt. So dividend payment is unlikely. And you have an example with Suzlon, which had a very high debt earlier. So they don't pay any dividends. So during 2007, 2008, it was a darling stock in the market. Everyone wanted to keep purchasing Suzlon, but it failed miserably. Dividends were not coming from this company after the initial few years of hype. So overall, these are the key takeaways from this video. So always stick to moderate yields for safe returns, 2 to 6%. Always focus on companies that keep growing their dividends, companies that have a payout ratio below 60%. Choose companies with strong cash flow, low debt, stable earnings, strong business model, consistent growth, and avoid stocks that have very high debt, that have declining profits, and inconsistent history of paying dividends. So always reinvest your dividends for compounding benefits. We'll talk more about reinvesting dividends in the next video of the series. Yeah, so that sums up this video. We'll talk more in the next video. Thanks a lot. If you like this video, please subscribe. Please share this with others.